Welcome to AI Mortgage News. Before we dive into today's massive bond market shift, make sure you hit that like button, leave a comment, subscribe to the channel, and share this video with anyone looking to buy a home. It helps us keep you ahead of the market. Geopolitical headlines are taking the driver's seat today, providing a much-needed tailwind for the bond recovery. We are seeing a significant move in yields that could have a direct impact on your next mortgage rate. Today is Tuesday, March 31st. At 10:35 a.m. Eastern Daylight Time, the focal point of the overnight news cycle was a report that administration officials said Trump is willing to end the war, even if the Strait of Hormuz remains closed. Markets rallied nearly as much just before the open, when Trump said the hard part is essentially done on the Iran war, and suggested other countries should take their own oil or buy it from the United States. This initial move took yields from 4.36% down to 4.33%. The pre-open rally continued that momentum, pushing yields from 4.34 all the way down to 4.30%. This is a moderate but very notable move, especially since it is happening the day after an already massive rally. War headlines remain the primary focus, even as economic data begins to ramp up. We are keeping a close eye on the 10 a.m. Eastern Daylight Time job openings data. If that report is spicy enough, it could command the market's full attention. This is because the recession fear trade is currently thought to be the key reason bond yields defied higher oil prices yesterday. Today's charts highlight a fascinating correlation. We see a strong link between bonds and oil price volatility in the short term, but that correlation disappears over longer time frames. In other words, markets are still paying attention to energy, but bonds look increasingly cognizant of growth impacts and potential recessionary signals. For those of you looking at FHA, VA, or conventional loans, this bond recovery is a breath of fresh air. When yields drop, MBS pricing improves, which typically leads to lower interest rates for US homebuyers. However, with the Federal Reserve watching employment data closely, we are not out of the woods yet. Keep an eye on those job numbers, as they will dictate if this rally has legs or if the Fed will need to stay aggressive. Comment, like, and subscribe for more AI mortgage news updates. See you in the next one.